There is a moment that most investors only recognize in hindsight, when a stock sits right in front of you at a price that seems almost too reasonable to be real. You look at it, you think about it, maybe you even Google it once or twice, and then life moves on, the price moves up, and you spend the next 2 years watching other people talk about how they caught it early. That feeling of almost getting it right. That is exactly what today is about. Because right now, in this market, there are 4 companies sitting at prices that remind seasoned investors of what certain explosive stocks looked like before they became household names. Not in terms of what they do, but in terms of how the market is treating them like they are ordinary when the fundamentals say otherwise. I went through dozens of companies to find these 4. The filter was simple. Would I be comfortable owning a piece of this business for the next 10 to 20 years? Not trading it, not flipping it when it pops, actually owning it, the way you would own a stake in a business you believed in deeply. Every company on today's list passes that test. If you want analysis built on real numbers and not headlines, hit that subscribe button right now. This is exactly the research most channels will not do for you. Here is what we are covering. 4 completely different businesses. One is the global transportation platform that partnered with autonomous vehicle companies instead of fighting them and now has 50 million loyal subscribers. One is the travel marketplace generating $4.5 billion in free cash flow from a model that owns 0 properties. One is the invisible toll collector sitting in the middle of every single digital transaction in the global economy. And one is the AI-powered marketing platform that almost nobody in retail investing has ever heard of, but that just delivered results that should make every growth investor pay serious attention. I am saving the most overlooked one for last. Let's get into it. Stock number 1, Uber, ticker UBZR. Current price around $80. Most investors look at Uber and immediately think about the autonomous vehicle threat. Waymo is on the roads. Tesla is building robo-taxis. The fear is that Uber's driver network becomes obsolete overnight. That analysis misses something fundamental about how Uber has actually positioned itself. Here is the reframe that changes everything. Uber is not fighting autonomous vehicles. It is building a marketplace and inviting every autonomous vehicle company to plug in as a supplier. Waymo, Tesla, and a dozen others compete fiercely against each other to win the autonomous vehicle race. Uber sits above all of that and says, plug into our network and access our hundreds of millions of customers. The technology layer becomes a commodity. What does not become a commodity is the customer relationship, the trust, the habit of opening that one app. Uber owns that. And that positioning becomes more valuable in an autonomous world, not less. Now let me give you the numbers that prove this business is not just surviving, but accelerating. In the first quarter of 2026, Uber completed 3.6 billion individual trips and deliveries combined, up 20% from the same quarter last year. Gross bookings hit 53.7 billion in that single quarter. Free cash flow was 2.3 billion in just 3 months. And here is the number that tells you this is a sticky business, not just a popular app. The Uber One subscription program now has 50 million members, and those 50 million subscribers are responsible for generating half of all gross bookings on the entire platform. Half. That is a loyal, recurring customer base that makes this business more durable than almost any competitor can replicate. The market cap is approximately 160 billion. They generated 9 billion in free cash flow last year. At current prices, you are paying roughly 18 times free cash flow. Return on invested capital has gone from negative to meaningfully positive in just a few years. Revenue has grown 38% annually over the last 5 years. Profit margins have expanded from 6.5% to 16%. Here is my honest concern. Autonomous vehicles are a real long-term question, and Uber's delivery business faces competition from DoorDash and Instacart that requires continued investment. If the autonomous transition accelerates faster than expected and Uber fails to maintain platform dominance, the thesis changes. My takeaway: 50 million loyal subscribers, 3.6 billion trips in a single quarter, free cash flow accelerating, and the smartest autonomous vehicle strategy in the industry. At 18 times free cash flow for a business growing this fast, this is one of the most undervalued large caps available right now. Strong buy on every meaningful pullback. Stock number 2, Airbnb, ticker ABNB. Current price around $120. Most investors look at Airbnb and see a travel booking website pressured by global uncertainty. They are missing the extraordinary business model underneath and the international growth story that is just beginning. Here is the reframe. Airbnb does not own a single property, not one. They are a technology platform that connects people with spaces to people who need somewhere to stay. Every booking generates a fee, and because they own no real estate, they carry none of the debt, maintenance costs, or depreciation that traditional hotel chains manage every single day. The result is one of the leanest cost structures relative to revenue in the entire consumer technology space. Now let me walk you through the numbers that make this business exceptional. Airbnb reported first quarter 2026 results and warned of regional weakness due to the war in Iran. Despite that headwind, the fundamental business remains extraordinary. Free cash flow over the trailing 12 months reached $4.5 billion. They received investment-grade credit ratings from both S&P and Moody's, reflecting the dramatic strengthening of the balance sheet. Gross profit margin sits at 83%, meaning every dollar of revenue they scale drops significant profit to the bottom line. And here is the international expansion story that most investors are not fully pricing in. In India, nights booked grew approximately 50% year-over-year. In Brazil, over 20% growth for the third consecutive quarter. These are not saturated markets. These are early innings. The total addressable market for alternative accommodation globally is enormous, and Airbnb has barely scratched the surface in the markets with the largest and fastest growing middle classes on Earth. Management is also buying back shares aggressively. In the first quarter alone, they repurchased $1.1 billion of their own stock. The total share count has dropped roughly 9% since buybacks began. When management puts that kind of capital into repurchasing shares, it tells you they believe the stock is undervalued relative to what the business is actually worth. The market cap sits around $86 billion, $4.5 billion in free cash flow, 19 times free cash flow for an 83% gross margin business with 50% growth in India. Here is my honest concern. The Iran conflict is creating regional demand weakness that could persist, and the stock remains under pressure from what was a very highly priced IPO that has taken years to grow into. My takeaway: $4.5 billion in annual free cash flow from zero owned properties, investment-grade balance sheet, aggressive buybacks, and international expansion that is just beginning in some of the world's largest markets. Every meaningful red candle is a buying opportunity for investors with a 3 to 5 year horizon. Drop a comment right now. Have you ever booked an Airbnb? Because if you have, you already understand exactly why this platform has pricing power no competitor can easily replicate. Let's keep going. Stock number 3, Mastercard, ticker MA. Current price around $550. If Uber is the global transportation platform and Airbnb is the global travel marketplace, Mastercard is something more foundational than both. It is the infrastructure the entire global economy runs through every single day. Let me be specific about what that means. Every time you swipe a card, tap your phone, or click to pay online, there is a network in the background routing that payment instantly and securely. Mastercard is one of the most critical owners of that network. They do not issue your credit card, your bank does. They do not lend you money, your bank does. Mastercard simply operates the rails that money travels across and collects a small fee every single time. They have 3.7 billion cards on their network right now. In just the first quarter of 2026, $2.7 trillion in total volume moved across those rails. $2.7 trillion in one quarter. And here is what makes this business model almost uniquely powerful. Mastercard carries zero credit risk. When a cardholder does not pay their bill, that is the bank's problem entirely. Mastercard already collected their fee when the transaction settled. They do not chase down bad debt. They just keep processing the next transaction and the next, every minute of every day, in every country that participates in the global economy. The most recent quarterly numbers showed net revenue growing 16% to $8.4 billion in a single quarter. Net income on that revenue was $3.9 billion, representing nearly a 46% net margin. Cross-border volume, where Mastercard earns higher fees on international transactions, grew 13%. And during that same quarter, they bought back $4 billion of their own stock. Gross profit margin sits at 78%. Net profit margin at 45%. Return on capital near 58%. These are among the best metrics you will find in any large-cap company anywhere on the planet. The shift from cash to digital payments is a secular trend that still has decades to run. In emerging markets across Asia, Latin America, and Africa, cash still dominates and card penetration remains relatively low. Every year that global commerce grows, every year that more transactions move from cash to digital, Mastercard collects more fees without adding meaningful cost. Here is my honest concern. If people stop buying things in a significant economic slowdown, Mastercard collects fewer fees. The business is not completely immune to economic cycles, even though it is far more resilient than most. My takeaway: the toll collector on the entire global economy, with 46% net margins, 58% return on capital, zero credit risk, and a secular growth tailwind that has decades to run. This is the definition of a business worth owning for 20 years. Now let me show you the fourth stock, the one almost nobody in retail investing is talking about, and the numbers behind it are ones most investors will have to read twice to believe. Stock number 4. Zeta Global, ticker ZETA. Current price around $25. Most investors have never heard of Zeta Global, and that reaction is exactly where the opportunity lives. Here is the reframe. Zeta Global is not a generic software company. It is an AI-powered marketing intelligence platform that sits between the world's largest brands and their customers, using proprietary data on 240 million Americans to deliver marketing that actually works. Think about what that means in practice. A major consumer brand wants to reach the exact customers most likely to buy their product. They do not just want demographics, they want purchase intent signals, behavioral data, real-time decision intelligence. Zeta processes 15 trillion signals annually to deliver exactly that. And unlike competitors who rely on third-party data that is becoming increasingly restricted, Zeta owns its data. That is a structural competitive advantage that gets more valuable every year as privacy regulations tighten. Now let me give you the numbers that prove this is not just a good story. Zeta has delivered 20 consecutive quarters of revenue growth, 20 consecutive quarters without a miss. That consistency is extraordinary in any technology company. Revenue grew 24% year over year in the most recent quarter. Adjusted EBITDA margins are expanding, and the company has been consistently raising guidance throughout the year. And here is the AI angle that most investors are not pricing in. Zeta's AI platform, Zeta Intelligence, can now write, test, and optimize marketing campaigns autonomously. That means their enterprise customers can run campaigns that continuously improve themselves in real time without human intervention. In a world where every brand is trying to spend marketing dollars more efficiently, that capability is not a nice-to-have. It is a competitive necessity. The enterprise customer base reads like a who's who of global commerce, and Zeta's net revenue retention rate sits above 110%. That means existing customers spend more every single year. That is the most powerful metric in any subscription business because it means the revenue base compounds without requiring new customer acquisition. Here is my honest concern. Zeta is still relatively small and competes against established players like Salesforce Marketing Cloud and Adobe Experience Cloud. Scaling against those competitors requires continued execution and significant investment. And the stock has been volatile as the market figures out how to value an AI marketing company. My takeaway: 240 million American consumer profiles, 15 trillion signals processed annually, 20 consecutive quarters of revenue growth, net revenue retention above 110%, AI that writes and optimizes campaigns autonomously, and a stock that most retail investors have never heard of. When the market discovers what Zeta is actually building, the repricing could be significant. Let me bring this all together. 4 stocks, 4 completely different businesses, one unified thesis. The market is treating all 4 like they are ordinary when the fundamentals say otherwise. If I had to rank all 4 for new money today, here is exactly how I see it. Number 1 is Mastercard, the toll collector on the global economy with 46% net margins and 0 credit risk. This is the highest quality business on this list. Number 2 is Uber, 50 million loyal subscribers, 18 times free cash flow, and the smartest autonomous vehicle strategy available. Number 3 is Zeta Global, 20 consecutive quarters of growth, owned data that gets more valuable every year, and AI that most investors have not discovered yet. Number 4 is Airbnb, $4.5 billion in free cash flow from 0 owned properties, with 50% growth in India creating a long runway. Here is the investing truth I want to leave you with today. There is a moment most investors only recognize in hindsight, when a great company sits right in front of them at a price that seems almost too reasonable to be real. They look at it, they think about it, and then life moves on and the price moves up. All 4 companies on this list are sitting at exactly that moment right now. The fundamentals are building, the numbers are real, and the market has not fully caught up to what these businesses are becoming. You can thank me later. Disagree with any of my picks? Tell me in the comments. Which one would you buy first? Which one do you think I have wrong? Subscribe for weekly research on where the real opportunities are hiding before the crowd arrives. No sponsors, no fluff, just the analysis. See you in the next one.